Good afternoon. Just waiting for a few more people to log in. But thank you all for joining us all. Week on from Labour's first budget for 14 years and the first by a female Chancellor. Having had a series of relatively uneventful budgets last week's was certainly not. It contained probably one of the largest single tax raising measures, which we'll discuss later. And it was also probably one of the biggest tax raising budgets overall that we've seen in history. Just make a few housekeeping points before I hand over to some of our presenters. This webinar is being recorded for anyone that couldn't make it, and should you wish to watch it all again, we will be putting it live on our website afterwards. What we'd like to do is sort of run through, I'll introduce the speakers in a minute. We'll spend about 35-40 minutes going through various areas. If you've got any questions, you can put them in the Q&A box, which should be at the top of your screens, and we'll look to pick those up after we finish the presentation. Any we can't get to, we will look to pick up with after the event. So in terms of what we're going to look to run through, we've got Sheldon Cole, one of my fellow partners, who'll be talking through the changes on capital gains tax, what it means, any planning that might want to be thought about before April next year. Following on from that, Tara Bell, one of the partners in Bridgewater, will be running through the inheritance tax changes, or at least what we know so far. What planning might be needed on that and what it might mean. And then finally, it'll be coming back to myself to run through some of the corporate tax changes, or what hasn't changed, picking up on probably one of the biggest topics, the national insurance increase, what that might mean, how it interacts with the minimum wage, and points to consider there, and then a few of the other comparatively minor points, but which still have a potential large impact for certain individuals and businesses. So without further ado, I'll hand over to Sheldon.
Thank you, Mark, and Tara. Thank you kindly for sharing my slides. Good afternoon, everyone. I'm just going to provide a brief overview of the capital gains tax changes announced in the budget last Wednesday, as Mark mentioned. As a recap, capital gains tax is payable by individuals, trustees and personal representatives on the gains made on the disposal of chargeable assets. Individuals who are resident in the UK subject to capital gains tax on gains made on the disposal of worldwide assets. Non-residents are subject to UK capital gains tax on the disposal of UK land, whether that's residential property or commercial property. There are also provisions for non-residents who own shares in UK property-rich companies to also be liable to capital gains tax. So the historic position at the moment is that gains are subject to, for individuals, are subject to different rates depending on the nature of the asset disposed of. So we've got different rates, or we have had different rates for residential property, other assets, and also carried interest gains made by investment managers in private equity backed companies. The rate of capital gains tax payable by individuals can also depend on the individual's income for the tax year of disposal, i.e. whether it falls within the basic rate income tax band, which the threshold for which is 50,270, or whether it exceeds that threshold. We've also got a number of valuable reliefs, business asset disposal relief and investors relief, both of which afford a 10% capital gains tax rate, and I'll come on to discuss those shortly. You may have seen in the press, there was a lot of speculation, in the weeks and months leading up to the budget, that capital gains tax rates would be fully aligned with income tax rates. And there was also speculation that business asset disposal relief and investors relief and the 10% capital gains tax rate would be completely abolished from budget day. So there was quite a lot of, adverse speculation, scaremongering, and pleasingly, my feeling is really that the capital gains tax in this budget is the tax that's probably got off relatively lightly. Certainly when we come to talk about some of the changes that Tara will discuss and also Mark later on. So Tara, if we could move on to the table. So this, my first slide here really just summarises the CGT rates that apply to individuals pre and post budget. So as can be seen, residential property gains, which were taxable in the first half of the tax year leading up to the budget at 18% and 24%, that position hasn't changed. And so for the remainder of this tax year, the rate will remain at 18% and 24%, depending on the income of the individual making the residential property gain. However, the rates that apply to non-residential property gains have increased from 10% to 18% for a basic rate where the gain sits within the basic rate band, and from 20 to 24% where the gain exceeds the basic rate band. And obviously those rates apply as from last Wednesday, the 30th of October. What's important to note in this context is that as well as increasing the rates to 18% and 24% with immediate effect from last Wednesday, the government also announced what they term anti-forestalling rules. And these rules apply where taxpayer has entered into an unconditional contract prior to budget day, but it completes after budget day. And where the rules kick in, or the anti-forestalling rules kick in, what happens is that the disposal date is taken to be the later completion date rather than the normal rule, which is that the disposal date is the date on which the unconditional contract for the disposal of the asset is formed. So these anti-forestalling rules can apply where HMRC can demonstrate that the securing of a CGT timing advantage was one of the purposes of entering into, having basically a contract that was entered into prior to budget day, but then completed afterwards. And they can also apply where a contract is entered into for non-commercial reasons in the context where the disposal is made between connected persons, i.e., parents to children, or where an individual transfers an asset into a trust, for example. So beware of these anti-forestalling rules. But essentially, I think in terms of the headline rates applying to individuals, we got off relatively lightly because what's happened is that the rates applicable have been aligned from budget day. Tara, if we could move on to the next slide, please. To summarise some of the other changes announced on budget day. Trustees and personal representatives of deceased estate. For the early part of this tax year, trustees and personal representatives would pay CGT on residential property gains at a rate of 24% and on other gains at a rate of 20%, flat rates. As from budget day, the 30th of October, trustees and personal representatives simply pay CGT at a flat rate of 24%. The CGT regime for carried interest gains of investment managers, the current rates are 18% and 28%, and they will remain the same for the rest of this tax year. From next April, that increases to 32%, and then from April 26, such carried interest gains will essentially be taxed as trading income in the hands of investment managers. So that's quite a significant change, and there's been quite a lot of press about that. Where I say other headline changes, the business asset disposal relief and investors relief, which we'll come on to shortly, these reliefs survive to fight another day. But we'll go on to talk about business asset disposal relief first of all. So if we could move to the next slide, Tara, that would be good. Okay, so just a bit of a recap on this valuable capital gains tax relief which can afford a 10% capital gains tax relief. So essentially, if we go back, this was a relief that was introduced back in 2008 originally, when taper relief, the previous regime, was abolished. So it applies to qualifying gains on, where an individual makes a material disposal of business assets as defined. It's been a very valuable relief, business asset disposal relief, in the context of owners of SME businesses. So it's always been a very relevant relief to consider for our client base. And it can apply where an individual owns shares in a trading company or and dispose of them, or they're a sole trader, or they're a partner in a partnership that carries on a trade. A typical scenario that we often come across would be a director or employee who makes a gain on the disposal of shares in his or her personal company, where he or she has held those shares for at least 2 years up to the date of disposal, and the company qualifies as a trading company or a holding company of a trading group. And there are quite a lot of defined terms in that, in the qualifying conditions. A personal company essentially is a company where the individual owns at least 5% of the ordinary share capital, is entitled to exercise at least 5% of the votes, and will be entitled to receive 5% of the consideration on a hypothetical disposal of if the whole company were to be sold. So if the conditions are met, then potentially that gain qualifies for business asset disposal relief at the 10% CGT rate. The relief has to be claimed. That's typically done in the tax return for the year of disposal. And each individual currently has a £1 million lifetime limit of qualifying gains. So gains up to that 1 million lifetime limit, if they qualify, benefit from the 10% CGT rate. Gains in excess are now taxed at the main rate, which obviously has just increased at 24%. So as I said earlier, a lot of commentators thought that business asset disposal relief could be abolished with effect from budget day. It's worth remembering that if we go back a few years, the lifetime limit had been £10 million. So an individual could pay 10% CGT on the first 10 million of qualifying gains. That limit was reduced to 1 million from March 2020. And so the value of the relief, at the current time, has been much reduced. But at least the relief will continue, and that is potentially a benefit to a lot of our clients. But what Rachel Reeves announced in the budget last week was that whilst the relief would continue, the applicable CGT rate on qualifying gains would increase from the current 10% to 14% where the disposal is made in the tax year commencing the 6th of April 25, and then to 18% for the following year, the tax year commencing the 6th of April 26. So over the next 18 months, the rate applicable will go from 10 to 14 to 18%. So from April 26, it will then align with the main rate that applies where a gain falls within the basic rate band. There are also, as with the main rates, the capital gains tax, these changes to business asset disposal relief are accompanied by anti-forestalling rules. So if a contract is made between budget day and the 5th of April 26, and it is completed on or after 6th of April 25, and the purpose of that is to try and lock into a lower tax rate, and there are non-commercial reasons for entering into the contract, then essentially this anti-forestalling rule could kick in such that the disposal date is deemed to be the later completion date, and so you don't get the CGT rate benefit you were hoping to get. I do wonder if with this relief, if business asset disposal relief will be fully abolished from April 27, but it will continue for the time being. Okay, turning to investors relief now. This is a relief that's not very well known, but it's run parallel in conjunction to business asset disposal relief since 2016 when it was first announced. So The scenario here is where investors' relief can be claimed, where an individual makes a gain on disposing of an ordinary shareholding in an unquoted trading company or holding company of a trading group, where a number of conditions are met. Firstly, the individual must have subscribed cash for ordinary shares on or after 17th of March 2016, which was when investors' relief was first announced in the budget that spring. The individual must have held the shares for at least 3 years and be making a disposal of them on or after 6th of April 2019. And also the individual shareholder who makes the disposal of the shares cannot be an employee or connected with an employee of the company in which the shares are held. So again, this relief is sort of, in a way, it's the opposite of business asset disposal relief, because it essentially applies where the individual shareholder is simply a passive shareholder. They're not an officer or employee of the company. But again, it's been quite a generous relief, because when it was introduced, it also had, as with business asset disposal relief, a 10 million lifetime limit. And that 10 million lifetime limit didn't come down in March 2020 when the business asset disposal relief lifetime limit was reduced, but it has actually come down to the 1 million mark as from last Wednesday. So again, this relief continues, but it's only the first million of qualifying investors' relief gains that now benefits from the 10% CGT rate. And mirroring the situation for business asset disposal relief, the applicable CGT rate will remain at 10% for the rest of this tax year, goes to 14% next tax year, and then 18% for the year after. And yet again, there are anti-forestalling rules if you took action to sort of enter into a contract before budget day with a view to locking into current rates. There are also sort of anti-forestalling provisions where an individual has entered into a share-for-share exchange. So what you can't do after budget day essentially is to make a particular election to bank what was the original 10 million lifetime limit for investors' relief. So we don't come across investors' relief very often, but we should remember that, you know, if there is a situation where an individual has subscribed for ordinary shares in an unquoted company and they're not an employee and director and they make a gain, then this relief continues to be available. It hasn't been abolished, albeit that the CGT rate that applies is increasing, as you will see over the next 18 months. Okay, I'm just going to move on now to make a few other observations on the new CGT regime. You know, just to sum up really some other points. And what I would say is many aspects of the pre-existing CGT regime remain unchanged. So the annual exemption, so the first £3,000 of gains for an individual in any tax year remains at £3,000. That's been permanently frozen. For trustees making gains, they have an annual exemption of £1,500. That limit can be reduced where the same set law has created more than one trust. We have a special regime where individuals, trustees or personal representatives make gains on disposals of UK residential property and are liable to capital gains tax. So in essence, the capital gains tax or a return has to be filed online and capital gains tax paid within 60 days of completion date. That continues as before. It's worth mentioning that a number of other valuable capital gains tax reliefs remain in the legislation and they weren't affected by changes announced on budget day. So we still have a situation where individuals can claim rollover relief. So if they are carrying on trading activities, dispose of an asset used in that trade, and then if they reinvest the proceeds, they can roll over the gain into the acquisition cost of the new asset. That continues. Pleasingly, CGT holdover relief, which again is a very valuable relief, which can defer a capital gains tax charge, that continues before, and that's available in a couple of different scenarios. There are two types of holdover relief. Holdover relief for gifts of business assets under section 165, and also what I call automatic capital gains tax holdover relief under Section 260, which typically applies where an individual makes a chargeable transfer for inheritance tax purposes. So, for example, simple example would be where an individual gifts a property that's standing at a gain into a trust. In that situation, the individual can hold over the gain and not be liable for CGT on making that what is the market value disposal of the asset to the trust. The reason for that is that that gift into trust is a chargeable lifetime transfer, which means that the settlor of the trust, the donor, can claim capital gains tax holdover relief. So essentially, the trustees would take on the asset with the the original base cost of the settlor. I think, and Tara's going to come on to the inheritance tax changes announced in the budget. I think there is going to be an increased focus on lifetime gifting of assets, including chargeable assets, during individuals' lifetime, given that the curtailment of full relief on agricultural property and business property. So I think there will be a greater focus on lifetime giving, and obviously with lifetime giving, you always have to consider the capital gains tax implications, as well as the income tax and inheritance tax implications, and commercial and family implications of making lifetime gifts. So I think there will be more call for CGT advice. My final advice, as ever, and this is not really linked to the budget, this is just something I would say in any event, is that whenever clients are considering acquiring chargeable assets, property shares, I would always advise them to take capital gains tax structuring advice in advance of the acquisition, and certainly also in advance of making any sort of disposal, because capital gains tax, there are still, because of these reliefs that are available, there's still a lot of opportunities to plan it or mitigate it or defer it. And although I haven't mentioned it on the slide, capital gains tax gains can also still be deferred where an individual makes investments into companies that qualify under the enterprise investment scheme or the seed enterprise investment scheme. There are obviously valuable income tax reliefs and reductions available for such investments, but the regime continues where, if an individual makes a gain on disposing of an asset and invests into an EIS company or an SEIS company, then there is the opportunity also to defer gains if that is considered appropriate. So the final comment is a lot of the CGT regime continues as before. The rates have gone up a little bit, as we've seen. The main rates of capital gains tax, business asset disposal relief and investors relief continue, albeit that the CGT rates are going up. And it wasn't quite as bad as we feared. So there's still opportunities to advise clients, private clients, business owners on mitigating capital gains tax. Thank you. Thank you, Tara.
Thank you. Right, so I'm just going to run through the inheritance tax changes that were announced in last week's budget. And we saw some of the biggest changes to the inheritance tax system that we've seen for decades. I think it's fair to say the changes weren't unexpected. Obviously, there was lots of talk in the media prior to the budget that we thought there was going to be some change to inheritance tax. But even so, it stirred up quite a lot of strong feeling and emotion, particularly in the agricultural sector. So the kind of headline changes, that the main things that were announced, firstly, was that the inheritance tax thresholds are going to be frozen until 2030. So we already knew that they would be frozen until 2028, but that's been extended for a further 2 years. So the thresholds we're talking about are the nil rate band. So that's the amount of assets on which you pay no inheritance tax. And that's £325,000 currently. Now, that's been at the same level since April 2019. So by the time we get to 2030, we'll have had that same nil rate band for 21 years with no increase. And obviously, asset values have risen significantly in that time, which just means that more and more estates are becoming liable to inheritance tax and falling within the charge. It also applies to the residence nil rate band. So that's the additional nil rate band that individuals can get where they leave a main residence to a lineal descendant, so child, grandchild, down that line. And again, that came in April 2017 initially, but again, we've had no increase in that. So we will have had that fixed at for a long time as well. And just a reminder that residence nil rate band does get tapered. So if the gross estate before any reliefs is more than £2 million, that residence nil rate band can be tapered, and that can come down to nil potentially. The second sort of big announcement was that pensions will become liable to inheritance tax from 2027. I'll talk a bit more about that in a second. And then finally, obviously, changes to agricultural property relief and business property relief and being subject to this new £1 million limit. The information that we've got on the changes to IHT are quite limited at the moment. So we've obviously been reading up on what's available, but there's not a huge amount of detail to how it will all work yet. So on pensions, generally pensions fall outside the scope of inheritance tax at the moment, so are not part of your chargeable estate. But from April 2027, any pension funds unused will become part of the estate for IHT purposes and will become liable for tax. So it's the pension administrators who are going to be liable for reporting and paying the inheritance tax due on the pension fund. And there's a consultation running now with the government on the process that will be required to implement the changes and how that's going to work. Again, it's going to only increase the number of estates that come within the charge to inheritance tax and is going to stop individuals being able to accumulate wealth in that tax-free environment within their pension. And really we're seeing an alignment of pension savings with any other savings that an individual might have for an inheritance tax purposes. It might be that individuals want to think about their pension funds and whether they take their tax-free cash from the pension fund prior to April 2027, if they haven't done so already. If that cash can be spent, then great, if there's plans for that. If not, it might be that you might want to consider making a gift of that cash out of your estate just to reduce the chargeable value of the estate altogether. So the changes then that we saw to agricultural property relief and business property relief, and this is probably what there's been most kind of comment about since the budget. So agricultural property relief allows an individual to pass on property or the agricultural value of property free of inheritance tax. So that includes things like land or pasture that's used to grow crops or to rear animals. It includes farm buildings, can include farmhouses, farm cottages, where all the conditions are met. When we talk about business property relief, that will cover an interest in a business, and that might be shares in a company or a sole trade business, a partnership business, or it might be land and buildings that are used in one of those businesses as well. And business property relief generally is at one of two rates, so either 100% or 50% relief. So firstly, there was a slight extension to agricultural property relief, so that's now been extended to include land managed under various environmental agreements. So that is a positive change. However, from April 2026, we then see this restriction to the amount of APR or BPR that will be available. So it is a £1 million limit on the combined agricultural property and business property that an individual holds. And where an individual dies owning both business property and agricultural property, that £1 million allowance is sort of prorated against both assets. And I've got an example in a minute to kind of show you some figures of how that might work. Where there's property in excess of the £1 million allowance, there will be some APR or BPR available, but it will be at a reduced rate of 50%. So that gives you an effective inheritance tax rate of 20% on that balance. The £1 million allowance won't be transferable between spouses. So with the nil rate band and the residence nil rate band, if the first spouse dies, leaving everything to the surviving spouse, that's exempt from inheritance tax. And if they don't use their nil rate bands, they can transfer. And then 2 lots of nil rate bands are available on the second death. But this £1 million allowance won't be transferable in the same way. The £1 million allowance will apply to trusts as well. So we've got trusts holding business property or agricultural property. They're also going to be subject to that £1 million allowance. And the new rules will also apply to lifetime transfers on or after the 30th of October, where the person who made that gift then dies after April 2026. So obviously the changes are going to affect lots of family businesses, especially farming families with valuable property. So Rachel Reeves said that the £1 million allowance would protect small farms. But if we look at the average size of a farm in the UK, it's about 220 acres. And that £1 million allowance is probably only sufficient to cover a farm of, say, 50 acres with land values as they are at the moment. So the CLA have confirmed that the changes will impact around 70,000 farms in the UK, and we also expect to see a knock-on impact to the wider rural and business communities as a result of the changes. I think generally businesses and landowners really need to plan early and create a retirement plan, which will allow assets to be gifted on earlier. So gifts more than 7 years prior to the death could avoid the IHT changes. And as Sheldon mentioned, we've still got holdover release available, which might allow us to pass on those assets early without a capital gains tax charge. And also, it will be really important to review wills and make sure that those are structured in the right way, because it could be possible to, you've got a married couple to get a £1 million allowance each if the first spouse actually leaves their agricultural property to the next generation rather than leaving it to the surviving spouse. So that will be really important to look at as well. Obviously, there's been some quite significant lobbying of the government already to kind of make the negative impact of the measures felt. So I guess we'll have to wait to see whether they take any notice of that and whether we get any changes in due course. But really, it's just really important for people to review their estates and think about succession planning earlier rather than later. So I have done just a quick example, which just shows the comparison of how the rules work at the moment compared to how they will work going forward. So in this example, I've got somebody who's died. They've got shares in a trading company which are worth £500,000, some family farm land which is valued at 2 million, their main residence which is worth 500,000, and some cash of £100,000. So total assets of 3.1 million. As the rules work at the moment, those shares in a trading company would get 100% business property relief. So they've got the full value of that is covered by the relief available. Similarly, with the farmland, as long as that 2 million is only the agricultural value of the land, that would also be covered by agricultural property relief in full. So both of those assets, there'll be no charge to inheritance tax on. That leaves £600,000 of assets chargeable. And I've, in this example, worked on the basis that this is the second spouse of a couple to die. So they've got a transferred nil rate band, 2 lots of 325,000. So actually their chargeable estate is covered in full by those nil rate bands. They don't have any inheritance tax to pay. If we compare that to what it will look like from April 26, so we've got the same gross assets of 3.1 million. So the next column, the £1 million allowance, is prorated across the agricultural property and the business property. The balance of those assets then gets a further 50% relief. So you can see now we've got £150,000 of the business property, the shares, is left chargeable, and £600,000 of the farmland is left chargeable. So our chargeable assets after the release is now 1.35 million. If we take off our 2 nil rate bands, we've now got a chargeable estate of 700,000, which gives us a potential liability of £280,000. So quite a significant difference to that family. In most circumstances, IHT liabilities for agricultural and business property can be paid in instalments over 10 years. But that does still mean that the business or the farm needs to be making sufficient profits to cover that inheritance tax and still allow the business owners to be, having enough to live from as well. Or it needs to be funded by other means. So again, I'll just reiterate that planning early is the most important thing here, I think. Right, over to Mark. Mark, you're on mute.
Sorry, always do that. Thanks, Tara. As a start, I'm going to run through the corporation tax changes or lack of, and then run through the biggest tax raising measure in terms of national insurance and a few other areas linked to it. So going with company tax, effectively it's good news in that there are no changes to company tax. What they have issued is a company tax corporation tax roadmap. It's about a 28-page document that effectively says they are not changing anything in terms of the main rate of corporation tax, which will remain at 25% during the course of this Parliament, and they will also leave the small company rate at 19%, which is welcome news, gives businesses a chance to plan what their tax liabilities may be. From a capital expense point of view, they've also confirmed that the two main reliefs being the annual investment allowance that gives businesses 100% relief on the first £1 million of qualifying spend in any 12-month period, that will remain until 2030. And alongside that, the full expensing regime that effectively gives 100% relief on certain qualifying expenditure without a cap will also remain. If it's qualifying expenditure that falls into the special rate pool, that relief drops to 50% as it currently is. In addition, the first year allowances that are provided on the purchase of electric vehicles, including cars, will remain in place for a further year to at least 31st of March 2026. That was due to expire at the end of March next year. And from my perspective, it was welcome that they've said they are not going to do any more changes to either the R&D relief or the patent box schemes, given that we've had changes at virtually every budget announcement for the last 2 years. To have that certainty of no further changes was very welcome. So moving on then to what's changing around national insurance. It's been well publicised now that they've made some very significant changes here, and it will cost businesses an awful lot potentially going forward. And on my next slide, I'll run into some of the financial impacts of that. So what has changed? They're saying from 6th of April 2025, the rate of employers' national insurance increases from 13.8 to 15%, so a 1.2% increase. On top of that, they have also significantly dropped the threshold, i.e. the rate at which that employer's national insurance becomes payable, from £9,100 down to £5,000. So for any employee you're paying more than £5,000 a year to, you will have to start paying employers' national insurance on from April next year. To try and protect some smaller employers, they have said they will increase the employment allowance from the current rate of £5,000 to £10,500. It's worth just noting that the employment allowance can only be claimed if your employer's national insurance liability is below £100,000 a year. So for larger employers, that increase in the employment allowance has no impact whatsoever. And when you're looking at the national insurance change, it's not just that I think has to be looked at, especially for a lot of businesses across the Southwest. It's looking at the also increase in the minimum wage from next April from £11.44 to £12.21 and the impact that will have as well. So to put some numbers on it, just to see what it would work, if we look at an individual employee working 35 hours a week, the current position on the current national minimum wage would be, you'd be costing you about 20,821 in salary costs and about an employer's NIC cost of 1,617. That same employee with no changes from April, you would have to increase their wage to the new current minimum wage. So it cost you about £1,400 for that employee. And on top of that, the employer's national insurance effectively increased by 966, comparing the national insurance on that salary to what it was before. That's an effective £772 increase on the national insurance. So overall, the best part of £2,000 to £2,500 increase on a single employee, with nothing changing within the business as a result of the combined minimum wage and employers' national insurance. If you then roll that forward on different salary levels above the minimum wage, so if I've looked at 30,000, 40,000 and 50,000 salary levels, what the impact on national insurance is, it's effectively increasing your cost per employee there by 866, 986 and 1,106. So as you move up the salary bands, the national insurance hike becomes less of an increase because the bulk of the increase is applying because of that drop in threshold. So it is hitting lower earners as far as the employers are concerned. Having been on a number of calls and discussions since last Wednesday, it is widely expected that although this is a tax increase on businesses, it is very likely that roughly 2/3, if not more of it, will ultimately be passed on to employees, and it will probably hit those lower earners more than the higher earners. It will be passed on either through reduced wage increases or by businesses increasing their prices and reducing the spending power of those individuals. I think the main talking point with our clients at this point in time is looking at what the impact will be and how you can best mitigate what is a very significant increase in your cost burden. The national insurance increase, as well as impacting on salaries, it also impacts the rate of national insurance payable on benefits in kind for employers. So if you're providing a lot of benefits to your employees, the cost of those benefits has also therefore increased by at least 1.2% from next April. And alongside that, what our payroll team is also hoping to get out over the next couple of months is details around payrolling benefit in kind. The government have also confirmed in the detailed budget announcements that they do intend to proceed with payrolling all benefits in kind from April 26. So roughly 16 months from now, everything will have to be payrolled. That will add an additional admin burden to businesses to do that and monitor the benefits as you're going along each month. Linked in with benefits, and it seems to have been a saga that's been going back and forth with the government, unable to make its mind around double cab pickups and whether they should or shouldn't be seen as a commercial vehicle. As the rules currently stand, double cab pickups with a load weight greater than 1 tonne will be seen as commercial vehicles on the whole. The relevance of that is twofold. If you're providing your employee with a vehicle and it's a double cab pickup, then the benefit to that employee is fixed. Doesn't matter what the list price or the emissions of that vehicle are. The benefit is fixed at 3,960 currently and is due to go up next year to 4,020, reflecting a CPI increase. Equally, from a business tax relief, capital allowances are available at 100% on the purchase of a commercial vehicle. So if you buy one, you'll be able to get 100% relief against your profits in the year you acquire it. What they government have said in the budget is from April 25, double cab pickups will no longer be seen as commercial vehicles, they will be seen as cars. The implication of that is, from a business tax relief point of view, you will no longer be able to get 100% relief on the purchase unless it happens to be an electric double cab pickup. Not aware there are many of those. And therefore you will only be able to get relief at either 18% or 6%, most likely 6% a year, so taking you a long time to get the effective tax relief. And from an individual employee perspective, it will mean the provision of that vehicle will be taxed as a car. The benefit rules on cars effectively could be a benefit of up to 37% as it currently stands on the list price of that vehicle, so significantly more than the current fixed benefit amount. What has been brought in and what they're saying is there will be transitional rules. So if you're already providing a vehicle to an individual employee and that arrangement was in place before April 25, then you will continue to be able to apply the existing rules, i.e. treating it as a commercial vehicle. Any new arrangements after April 25 will be subject to the new rules. So any employer providing commercial vehicles to their employees just needs to look at what the implication may be, and it may be for some people it's no longer worth providing the vehicle. It's better providing effectively a car allowance through increased salary. Linked to that, and it's not unexpected, the government have also indicated what the benefit in kind rates will be on zero emission vehicles and other vehicles all the way through to 2030. Zero emission vehicles, when they first came in, started at a 0% benefit in kind rate. It's currently sat at 2%, which is very attractive and has been encouraging businesses to provide electric vehicles to their employees. That rate of 2% is gradually increasing, and by 2028 it will be set at 7%, and 2029 will be up to 9%. And alongside that, the other bands are increasing by 1%, so the current maximum rate of 37% will increase to 38% and 39%. In terms of 4 other sort of sundry points that are worth having an awareness of, for anyone that is late paying their tax liability of any kind, whether it be corporation tax, income tax, PAYE or VAT, the current rate of interest that HMRC charge is base plus 2.5%, so about 7.5% at present. From April 25, they are making that more penal and saying it will become base plus 4%. So if you have got any payment arrangements or outstanding liabilities, it is worth reviewing. Is it better to continue to have those arrangements with HMRC, or maybe financing them with third parties where the interest rate may be more attractive? One of the changes that came into effect from last Thursday that impacts property transactions is on stamp duty land tax on residential properties where you're buying a second property. The surcharge rate that was at 3% was uplifted to 5% for any transaction completing after the 31st of October, or on or after the 31st of October. That is likely to depress some property transactions, and if you hadn't managed to complete them ongoing, I am starting to see transaction prices being renegotiated as a result of that. Third point, one area we have seen a particular interest in over the last few years on succession is the use of employee ownership trusts. They're attractive in that they give a current owner of a business the opportunity to sell their business to the employees via an employee ownership trust and pay no corporate capital gains tax on that. Thankfully, all of those reliefs still remain. What the government have said is they've made a few admin changes in that the disposing shareholder now has to provide more information on their tax return to be able to claim the relief. And as far as the employee ownership trust is concerned, the changes primarily revolve around making sure that all of the trustees, or the majority of the trustees, are onshore, so that it's not allowing businesses to be moved outside of the UK, or the control of those businesses moved outside of the UK where no tax is being paid. And then finally, it was reconfirmed within the detail, although not formally stated by Rachel Reeves when she spoke, the furnished holiday let tax status of residential properties is being abolished, and that is going ahead from April 2025, which then has impacts for people that have been operating as holiday lets. The legislation on that hasn't really changed from when it was published a couple of months ago. But it's just reconfirming that it is definitely going ahead. That covered the main areas within the budget. So it's sort of open then to any questions, and I had seen some coming in whilst the others were talking. Sheldon, I don't know if you wanted to pick up George's question on what qualifies as a residential property when you're looking at buy-to-lets and holiday lets.
Yeah, so let me just go up to...
Yeah, that I think they're coming through in the chat rather than in the Q&A bit.
Okay. Okay, I mean, there is a particular definition of... Sorry, I'm echoing for some reason. Turn the volume down a little bit, maybe. There's a particular definition of what comprises a residential property or a dwelling in the capital gains tax legislation. I guess the main implications now where an individual disposes of a residential property, and the definition relates to is it suitable for use as a dwelling. That, you know, it can be quite a contentious area, but normally you would know a dwelling and whether it's suitable to be occupied as a dwelling. In most cases, there can be one or two grey areas. Just thinking about the CGT regime post-budget for residential property, you know, we've seen that the main rate continues at 24%. As Mark said, the furnished holiday let special tax regime, where someone carries on a furnished holiday let business, that's being abolished from the end of the tax year. And given that business asset disposal relief hasn't been abolished, I guess it is still feasible that an individual could make a disposal of a residential property that qualifies under the furnished holiday let rules at a gain, and make a valid claim for business asset disposal relief and the 10% CGT rate. It's quite a complex area because to benefit from business asset disposal relief, as I mentioned at the start, there has to be what's known as a material disposal of business assets. So if an individual holds a number of different furnished holiday let properties, but say only sells one, then that is probably just the disposal of an asset used in that furnished holiday let business, as opposed to a disposal of part of the business, which is what is required for a business asset disposal relief claim, you know, and 10% capital gains tax rate. I mean, the other question George has raised, I mean, he's mentioned, you know, property owned via a limited company. There can be a number of tax issues around a company owning residential property. I mean, essentially, gains made by a company on the disposal of residential property is subject to rates of corporation tax, as Mark mentioned earlier. So essentially a 25% rate of corporation tax. You also have to be mindful where a company owns a residential property, there are other tax implications. For example, if the directors or shareholders occupy the property there aren't suitable arrangements put in place, that can give rise to P11D benefit in kind and Class 1A national insurance implications under the accommodation benefit rules. Also, a company, if it owns a residential property which is valued at more than £500,000, has to be aware of the annual tax on envelope dwellings regime, that ATED regime, and normally has to file an annual ATED return or claim relief if that property is being let to unconnected third parties. So there are complications around owning residential property through a company. Always important to take advice, but there is, I think, still a window of opportunity if someone owns a furnished holiday let property personally to benefit from a 10% CGT rate, albeit only in certain circumstances. And I know the draft legislation for the abolition of the FHL regime does contain some anti-forestalling rules. So, individuals need to take advice on their specific circumstances.
Thanks, Sharon. Tara, Francesca's asked around spousal exemption on first death applied to transfer of pension funds.
Yes. Yeah. So the short answer is yes. So you would specify that your wishes to the pension trustees were that you wanted it to go to your surviving spouse, and as long as that is where it goes, then the exemption applies. Obviously, it is at their discretion. But yes, if that's where it ends up going, then the exemption applies on first death.
Thank you. Karen, you just wanted clarification on national insurance only apply to businesses or charities with 4 or more employees. There is no carve out for the increase on the national insurance. I think what you're thinking there is if you've only got around 5 employees, then the increase on the national insurance subject to their level of salary should be covered by the increase in the employment allowance. So it should have no overall impact, I think, is where that point has come from. And then Marcel recently just asked should you be dropping your salary down because of the increase to avoid any national insurance. If you drop it down to the 5,000, so you're paying no employer's national insurance, I don't believe that's high enough to qualify as the minimum amount for an employee for state benefits. So for state pension, I think the limit on that is about 6,000. But each individual case would need to be looked at as to what is the most efficient, as to whether you take it as salary or in some other form. But I certainly wouldn't recommend just dropping it down to £416 in April. I'm just flicking through.
Mark, I'd probably just chip in there and say that where we talk about sort of extracting profit from a company, then it can still be very tax efficient for the company to make employer pension contributions on behalf of a director shareholder. There was also some quite a lot of speculation about whether employer pension contributions would be made subject to some form of employer's national insurance contribution, but that hasn't transpired. And so, in a lot of cases, the company will get a corporation tax deduction, say 25% corporation tax in the accounting period in which the employer pension contribution is paid to the shareholders' SIP or pension scheme. And there's no income tax or national insurance provided the contribution falls within the certainly no income tax provided the contribution falls within the individual's annual allowance, and obviously carry forward relief can be taken into account. So that avenue of planning for extracting profits remains post the budget. I could see that we have Ian Andrews, one of my partner colleagues from Westcott's Chartered Financial Planners on the call, and so it's obviously a regulated area, and so I'm obviously restricting my comments to the tax implications, and Ian can advise on the merits or otherwise of making either employer contributions or personal pension contributions.
Okay, I think the only other, there's a couple of questions from Michael early on. A structure with trusts where you own nothing but control everything, I think would be is very difficult to achieve and would need to be looked on a fact-specific basis. Effectively, it could be achieved, but it probably wouldn't achieve the tax angle you might be looking for if you retain control of everything. But certainly happy to pick that up separately. And sort of linking in with Sheldon's comments just then, you also asked about transferring a SIPP to a child now. That's more one for our financial planning colleagues, but I'm not aware, and I don't know whether Sheldon or Tara can either confirm or deny this, but I don't think you can transfer a SIPP to a child. I don't think you can transfer your SIPP to anyone else during your lifetime.
Not that I'm aware, no. Can I just comment on that trust query that I think Michael raised, which is that, you know, obviously, as Mark said, there's various anti-avoidance legislation surrounding the use of trusts where the settlor, i.e. the person who contributes assets to the trust, can benefit or is a potential beneficiary of the trust, both from an income tax perspective, it's the settlements, income tax, anti-avoidance legislation, but more importantly, perhaps from an inheritance tax perspective, with the gift with reservation of benefit anti-avoidance rules. So any gift of asset to the trust, you know, that essentially would be ineffective for inheritance tax purposes, where the settlor of the trust is if they or their spouse are a beneficiary or a potential beneficiary of the trust. So the creation of a trust, there can also be problems from in terms of claiming capital gains tax holdover relief, where an asset is gifted to a trust and the trust is settlor interested. So it can be a real minefield, and again, specific advice needs to be taken on any sort of inheritance tax planning measures involving trust.
Thanks, Sheldon. And that is effectively the hour we'd allocated for this. I can't see that there's any other questions. So I'd just like to thank Sheldon and Tara for their presentations. And if anyone has any other questions, then by all means, they can get in touch with their usual Westcott's team member, or by all means, drop one of the presenters a line. All our contact details are on the website. And as we said, the slides for this, plus the recording of the webinar, will be made available on our website shortly after we've finished here. Right, thank you.